Hello everyone, this is Mohammad Akif with Akif CPA, and then today we'll be talking about financial ratios. Why are these important? Why a business owner should be looking at them, and then how they can help you. A lot of business owners don't know about these ratios is because their accountant, their bookkeeper, or their CPA is not providing them. We normally provide a report to our clients on monthly basis. These are monthly reports that includes those ratios to talk about how things are happening, what is happening, why they're happening, and what you can do to make changes. So if you're not getting those reports from your accountant, you need to think about changing them because it is important, especially with what is happening nowadays with the uncertainty, with things slowing down in an economy. We need these reports. You need these reports to help your business. You need these reports to save taxes. And then, so if you're not getting those reports, you need to change your accountant. Email us at info@akifcpa.com. We can help you, and then we can really help you deliver what you need to help your business grow, to save taxes too. All right, so let's get into the detail. I'm going to share my screen with you in terms of, I'm going to see what, I'll briefly go over the report that we normally send to our clients. You can get this report too, which can really help you take your business to the next level. So let's look at the report. All right, so this is technically what we do is, if you do sign up with us, we if you are we are your accountant or your bookkeeper or CPAs, we can get you this monthly report, this monthly financial report, to help you. This report is to help you understand your business, understand your operations in terms of data, in terms of numbers, and then really to make decisions that can help your business grow, reduce cost, increase efficiency, save taxes. So if you're not getting this report, I will highly recommend to get this report. Find a CPA that can get you this. If you cannot, then of course email us at info@keepcpa.com and we can help you. So quickly, I'll go to the report. What is this all report about? And then we'll get into the ratios, and then what this report really gives you when it comes to this. So this is technically, this report has everything in it that you need to know about your business. So this executive summary talks about your revenue, talks about your expenses, what has changed this month, what has changed this whole year. It talks about what are your top expenses, and then your net profits. Are you making money, or you're losing money? It does also comparison, right? I mean, this is something really good. We do have a certain report where you can also compare with your peers in your industry. That's something that can also help you. So if you want that, we can customize the report for you. So good stuff. I mean, it talks about a lot of this good stuff. Balance sheet gives you in comparison, in variances. The great thing about this report is that it is live data. That means you can actually hover on the numbers. It can tell you stuff. It can really tell you in terms of your details, in terms of look at the top transaction. It gives you all the details right away. So this is not something like PDF where somebody will send you this, and then you only have one number to click on. But this gives you a detailed breakdown, transaction by transaction. So that's the reason I love this report. I highly recommend for our clients who are business owners. This is so important for your business. I cannot stress enough. So it gives you a whole bunch of stuff. Again, profit and loss, balance sheet. Let's go to profit and loss and see what we're talking about. Let's say, for example, look at the sales right here. It tells you the trend, what is happening from last year to this year, where the numbers are. Trump transactions, right? I mean, it will tell you who gave you the most money in that month, without even going to another page, another detail, right? So that's the reason I love this report. It gives you a whole bunch of stuff, and then again, multiple things in there. And the best thing about this report, that has the ratios, is the financial health scorecard. This is the great thing about this this report. We can set targets within your company and say, hey, this is what we want to hit. Are you above? You're below? Are you crossing the target? Where you're heading in terms of operations, in terms of finances, right? So look at this in terms of total income. Is it increasing? Yes, versus the target. This thing will always. So look at this. Gives you all the detail versus target, where you are. Gross profit. I mean, where you are. So these are good things that I talk about. So let's get into the reason for this video is to talk about ratios, right? So let's talk about liquidity ratios. I want to start off with liquidity because that's the simplest one. Cash. What is the current ratio? Is it going up or is it going down? I'm going to talk about how do they calculate these ratios, so you can see why this report is so important, right? Debt to days, how much you're paying. Creditor days, how much these people are paying you. And your inventory, how long is your inventory in there? So these are all within the ratios, the quick ratio too. And then I'll go into detail what these are. Let's just go down and talk about what are these. So there you go. So liquidity ratio, right? Cash and cash flow talks about this. Growth in cash balances signifies that the company is generating or retaining more cash over time, right? So look at the ratio, 2.98, right? 3, that's what it says. The current ratio compares the company current assets. The higher the ratio means the company is in a strong position. So the higher the number is, that means you're more stronger than before. You're getting stronger. You're getting stronger. So this is the same thing about debtor days in terms of creditor days, inventory days. Inventory days ratio indicates average number of days that an item of inventory is held in stock. The lower the ratio, the faster an entity sells this inventory. This is talking about layman terms, breaking it down for you. I don't think so you can ask for anything more. This is something that is doing a wonderful job. Quick ratio, this is what banks look at too. And this quick, ability to pay short-term obligations, right? The most liquid assets are assets that can be converted to cash. The quick ratio, also known as the asset test ratio. I'm talking about loans. When are you going for loans? This is the ratio they're looking at, and they'll tell you how they're calculating. That's the great thing about this. It tells you how this is being calculated. So, it's just not giving you numbers. It's also explaining you how this works, right? So, operation efficiency. How great is your operation doing, right? Financial leverage, return on equity. Let's go down and talk about these two. Operation efficiency, right? The operation efficiency ratio is identical to net margin and represents the amount of profit that an entity retains. That means you are keeping it after incurring all the cost. The higher the ratio, the more profit it generates. It gives you that detail, what you need to do for the operation efficiency to go up, right? The higher the ratio, the more profit is generated per each unit of sale. Financial leverage. How much debt entity has utilized to finance its business? The higher the ratio, the more debt entity is using. So that means the ratio needs to come down. This should not be a higher number. It should be a lower number. That means you are using finances, but not as much. You're using loans, but not as much. So that means you are running good on cash flow. Your business model is good. Your idea is good. It is working. It is selling. Things are happening your way. You don't need a lot of loans. Of course, you need loans to grow sometimes, but that doesn't affect your operations in the same way, right? This is just to expand. The ratios are also maintained. Return on equity. The return on equity ratio is considered a measure of how effectively management is using an entity assets, leverages, and expenses to create profit for shareholders. ROE. I know a lot of people talk about ROI, but ROE is also important. Return on equity. ROE can be increased by improving operations efficiencies, right? So this can be improved on. This is what I'm talking about. When you get this report, you get to see what needs to be worked on. Asset use efficiency or increasing financial leverage via more debt financing. So these are ratios that you need to be looking at on monthly basis, on quarterly basis, on yearly basis to help your business. This is so important. And this report will get you what you need. If you're not getting this report, if you don't have your hands on this report, you are behind. Things are changing fast enough, right? With the AI and with the economy, things are going. We need to have more data, more tools, so it can help us. This is important. As a business owner, as a small business owner, you require this now more than ever. So again, email us at info@akifcpa.com. We can definitely help you. We can help you with the accounting, with your bookkeeping, getting you this report on time. If you have other CPAs, good too. If you just want one part of our service, we can also deliver that too, right? So again, we do accounting, we do taxes for small business and medium businesses. We do tax planning to help you save taxes. So any tax planning must come with good and timely bookkeeping. If you don't have timely and good bookkeeping, you cannot save taxes because you cannot do planning. You don't have any data on time. We're always playing catch up. When you're playing catch up, that means you're behind. There will be a never time for you to save taxes. I don't want you to pay the maximum tax. I want you to pay the minimum tax. Email us at info@akifcpa.com and we can definitely help you. Take care. Thank you.